Hey guys, Glacier Path Trading here, and I'm going to talk about my final overarching GameStop theory. I first want to say that my video on my channel, the only other video, and my initial idea of a February squeeze into March squeeze, I believe is probably going to be wrong. And it's because I've been thinking about the chart, the structure, all of the different technical analysis, accumulation, distribution, volume price analysis, Fibonacci, structure, just the way that GameStop has moved. I've been thinking about all of this stuff in sort of my own way, and have not really been noticing what's really been going on here. Okay? And I want to share this all with you. This is just my personal theory. Okay? So let me first share with you this. This entire chart is fake. From the moment we squeezed with the cat, from the moment they turned the buy button off in January of 2021. I first want to say it's of my opinion to stop trying to time swap expirations. It is a private agreement with a fund and a prime broker counterparty. That swap agreement can be modified, renewed, whatever, at any time, at any point. And so my theory is that there's only one swap going on at one particular cycle. And I've highlighted it here at the top here with the flags. Now, indicators that are created by anyone in the community, although well-intentioned, I'm sure, and some correlations, some interesting dynamics with the indicators. I believe they're all dumb. I believe they do not do anything. I believe all technical analysis is derivative with GameStop specifically. And what I mean by that is price and movement happen first. Technical analysis confirms what we are seeing. And that gets a lot of people into trouble. The indicators get a lot of people into trouble. I am having a full blown reversal of my entire opinion of what's going on in this trade. Can you trade GameStop? Yes, you can. And I'll talk a little bit about that later, but I want to get to the overarching theory here. The key is the short ladder algorithm. The short ladder high frequency trading within a range that is predictable from support and resistance, right? So specifically resistance in the channel, you get these pops when implied volatility is low, when liquidity is dry, they pop the stock, they have people getting hyped on X and in the community on Superstonk and Reddit and all this stuff. And then they get to the resistance and they modify the swap, they get the liquidity they need, and the synthetic exposure is back, and we drop back down to support. So you're seeing the resistance and support within the channels that I created from 2021 to 2024 in the next squeeze with the cat return, and then the current channel as well. They are typically going to always be in a downward sloping channel. The reason is because when you have the markup, and we're going to zoom in here, when you have the markup, you have this peculiar setup. You have the squeeze, you have the deep retracement, you have that acting as the floor, and then you have the follow-up move almost to the top of the move. It's almost a double top, but not quite. It's usually the 786 Fibonacci. That's marked there by the swap ceiling, and then you give it some time and you find some highs, find some lows, and you develop your channel. Okay, so in this particular case, it lasted 3 years. Swap continue gets modified for 3 years, and then you come down to where the markup retraced. And literally 3% off this price of $9.72, you find the bottom at about $10, right? Hitting the bottom of the channel one last time, and then you V and you squeeze. Well, look at 2024. It's the exact same. You have the markup from previous support. You have the support candle, the 2024 floor, which is 1770. And you have the retracement back up at the 786 Fibonacci. You have your swap ceiling. What this means is price is never going to break that ceiling. It's never going to break that ceiling. It's why the counterparty prime broker will gladly go into a swap agreement. And then you wait for one thing I noticed as well is that after this swap agreement, you have this congestion phase, which means nothing. And then you have to wait until you get resistance support in a downward channel. And then we're headed, and this is the big part, we're headed to the 2024 floor at 1770. We're not going to touch it. We can't break it. We can't break it. Otherwise, this whole thing, the whole theory breaks down. I believe we're going to about $18 and some change. We're going back down to this support channel here. And before anyone says anything, if I'm copying anybody's work, or I'm sure other people have similar price targets, I said on my X, and you can look this up, and I will post it on my X as well, but my bear case in March 2024 was $15 to $17. It's because I had this overarching theory going on. Actually, let me go ahead and just let me show you right here. I'm just going to show you right now. It's kind of blurry. Okay, there you go. GME bear, March 2024 dump, similar fractal, 15 to 17 bottom in March 2026. Okay, so that was my bear case. So that was posted, I believe, in January. January or December, I can't remember. Okay, so continuing on, where was I? Here we go. Okay, so what does that mean? I believe, and this could be wrong. Go ahead and prove me wrong. Prove me wrong on this, because I would love to squeeze from here. This means that we are way too far off the 2024 floor. They're going to modify this swap, and we are going to fall back down into this spring. Okay? And I don't know exact timing, maybe April, May again. And then we're going to mark up. And we're going to mark up, I don't know what price exactly, come back down for the new floor. That's going to mark the new floor, and then you're going to have the exact same thing, another retracement high, and then that's your new swap ceiling. So one thing I wanted to point out is time and pressure is the solution. From 2021 to 2024, you had your one giant swap operating. And I'm not going to get into is there 5, is there 10 swaps, expiration here, expiration there, try to time it. I think that's all nonsense. And I don't think that helps anybody. You can't time a swap expiration when they can modify the swap at any point. Okay? We're dealing with some really shady stuff here. And so time and pressure is the solution. So why do I say that? Because it took 3 years to get down to support. They had a lot of wiggle room here, right? A lot of liquidity, and frankly, the interest rate of the swap with the prime broker was probably very low, because GameStop was fundamentally not as good of a business, and they didn't have as large of a cash position. You get my point. But what's happening here is you get the halt on the markup, and then they organize everything, right? They drop it down, people sell, people panic sell, you set the floor, then you have short covering, retracement, and then you set the swap high. Now, what's interesting is this time to get close to support, we're only on 2 years. Okay, so 3 years, 1,132 days, and a projected 685 days. I mean, that's obviously a little bit more than 50%, but it's shorter. And frankly, the price action has been more flat. If I were just to show you here, even though the parallel channel is tilted to the side here, like this one, this is clearly more volatile to the downside, and this clearly went more flat like that. So I expect a similar thing to happen, but with less pressure. and also to happen quicker. So this channel is probably going to be a little bit more flattened out as well, possibly even like this, right? Because why? Because it's going to take more risk from the prime broker to accept an agreement to hold synthetic short positions so that the short fund who doesn't want to increase short interest and do it synthetically, they're going to have to pay more to do that. And my overarching theory is that when the floor of GameStop, its cash position, its total valuation, right, is higher than all-time high at $120, I think what you're going to get is you're going to get a big move like this. You're probably going to get some type of crazy crash down, maybe not that crazy. But let's say in 2027 we're like pushing $800, $1,200, whatever. And then you come back down, it's going to be something really sharp, but then it's going to MOASS. And I think that's when MOASS happens, is when essentially the floor is higher than all-time high, and basically no one's going to touch the stock anymore in terms of holding synthetic short pressure. And so I think that is all timed up perfectly to happen in 2028, 2029, MOASS right before the global financial crisis 2.0, the Great Depression 2.0, the AI depression, everything Michael Burry has been talking about and everything that I see. So, AI stocks, energy stocks will be pushing, I think, the most in 2028, 2029, 2030. GameStop will MOASS, and then you just get the Great Depression 2.0. You get a complete collapse. Now, okay, so one thing I want to point out here is right below, we have the RSI daily. We have a point where the RSI hits the top, and that's around the markup. And then you get the final bottom. Let's actually zoom in on the RSI here. Top to bottom here, 3 years, okay, 2021 to 2024. It really was more than 3 years, right? It was January 2021 to May or April of 2024. So you're actually looking at like what, almost 40 months. And then look how much less time it took. Okay? So here's what I do know. I believe we're in the sequence of preparing to squeeze, preparing to mark up. We are definitely in that sequence. I, however, believe we've got to get closer to 1770. We've got to get to probably $18. Okay? And then they're going to mark up the price. And then they're going to do it all over again. Now, why do I say this with some confidence? Because here is the deal, and this is tinfoil. Forensic psychology states that you should always look for what does a party have to gain in a crime. Well, frankly, the trap shorts, Ryan Cohen and GameStop all have something to gain by allowing these short algorithms, these high frequency algorithms to continue. The trap shorts, they stay alive. They have more time, right? Not only that, but the shorts can make a hell of a lot of money moving these short ladders in place. Baiting retail, pushing fractals, pushing indicators, pushing swap expirations, having people on X saying that they know when the next swap is going to expire. I fell victim to that and I was naive. I thought that maybe I could track that as well. I am done doing that. And then also the timing of all this. I believe there is a timing element so that they can prepare several institutionals to collapse in the Great Depression and have that money changing of the guard happen all at the same time so that nobody is caught off guard. It will be organized. It will seem chaotic, but in behind the scenes, I believe that they're sort of already organizing the musical chairs in that situation. Now, what does our boy, our CEO, Ryan Cohen, and GameStop have to gain as well? Well, look, it's an infinite money glitch. If he knows that these short algorithms are running at resistance in a channel every time, why not dilute at the top? That's what he did this cycle, and I think he even said in an interview he made a lot of mistakes. I think what's interesting is I think maybe one of those mistakes was not taking advantage of what he probably knows is that these short algos are running at resistance. And so he definitely took advantage of that. But let's also keep this very fair. Ryan Cohen also has not pushed hard against naked shorting, against the whole thing with Jane Street, all of the stuff with the shorting and the illegal stuff. He has actually said, bring it on. He said, let the shorts short because he's going to dilute and raise a war chest of cash. And that's what he did. That's what he did so far. And he gets to become the next Warren Buffett of our generation. GameStop by 2027, 28, 29 could have two companies, could have three companies under their wing. We don't know. Especially if he continues to raise more money and the business continues to grow and expand. And so the hard part is over, which was 21 to 24. We had the cat return, and they just have to keep acquiring companies and continue to expand because it's clear that, Michael Burry even sees this path as well. So what am I all saying here? Can you trade GameStop? Yes, you can. You can simply sell calls to people that want to buy them at a established resistance once we have the channel. You can buy calls at support. You can do spreads for income. You can do all kinds of things. I'm not going to persuade anybody on how to trade GameStop or anything like that. Or you can simply just look at this and say, hey, the closer we get to 1770, which is the 2024 floor of the markup, the more likelihood I have a good reward to risk ratio. And I believe that's what's happening. We can stare at these charts all day and look at these, this is a really nice Wyckoff, whatever, distribution, accumulation, and this is, it's above the daily 200 moving average. It's, higher lows, it's blah, blah, blah. But the reality is, from what I see, this sequence on the markup marks everything. It marks the floor, it marks the ceiling. You wait for the absorption congestion area, and then you get your channel. Okay? That's what I see. So what does this mean for like the short term of GameStop? Well, I actually do expect $17 to $18. I do. And if I'm wrong, prove me wrong and just gap up or squeeze right here, right? Just freaking maybe, just do that. Just do that. And I would gladly accept that as well because, I do take, on occasion per week, I do take a few cheap lottery calls. I also take some swing positions as well to prepare and to also cover risk to the upside and downside. But I look at this and this is a fake chart, guys. This is a fake chart. This is not organic. This is not organic. This is riding the worm. This is what he was talking about, Roaring Kitty, riding the worm. Right? So I'm making it very simple now. I'm making it very simple. And if you want to actually look at the pre-squeeze, it did this exact same thing in a sense, right? So you have your low, you have your high, you pushed up, you created your ceiling, and then you went back to support, and then you squeezed. That's all GameStop is doing basically. And I believe this was all agreed upon deal. I believe the CEO knows about it. I think he's allowing it to happen because he's going to be the next Warren Buffett, because he's going to take advantage of it now. I think all TA is kind of pointless. I mean, you can look at the RSI, you can look at the MACD, you can look at all kinds of things, VPA, Wyckoff. You can look at, even fractal patterns. You can look at, anchored VWAP, all this stuff, right? All this stuff. But unfortunately, it's derivative. It's not, price action comes first, and then the TA confirms. But it gets people into trouble, and when you start having a ton of accounts saying when the swap is going to be due, well, you set up a lot of people to be, exit liquidity. And when GameStop goes down to support and implied volatility and liquidity starts to really dry up, and they can't quite push it down anymore, well, then you get some organic movement to the upside back to resistance, and then you get a modified version of the pre-existing swap, right? That's all I got for you guys. So what am I looking for? I'm looking for $18. I'm looking for 18 and change, maybe by April 20th, maybe perhaps. And then I think a certain somebody is going to come back because the CAD doesn't buy support, he buys deep value. And deep value is next to the previous markup support because that's where all the shenanigans have went down and everything else is noise to the cat. So I think the cat's coming back once we get to about $18 or so. Maybe even like 17.90, I don't know, but this whole theory it breaks down if you break 1770. Now, there is a opportunity if we were to just squeeze up from here. You could still make the argument that it's still in support. I mean, it is further off 1770 and further off this candle than it was in 2021. So I'm not saying that it's impossible. I'm just saying it's more likely that we come closer to support because there's a lot more room. There's, what is that, 30%? I don't think the shorts are going to leave. I don't think this algorithm, right, is going to leave 30 some percent on the table here. Yeah, you're looking at, I mean, to $18 from the previous high is 30%. So that's what I got for you guys. This is my own theory. This is my own work. And I hope you enjoyed the video. Take care.